I want to talk to you about the share market versus the bond market. So I want to move away from the Greeks, and hopefully, Steve, that's a good answer for your question. We've got a chart that you've brought in about the share market versus the bond market, and I think one of the things that Don's got a different business. When you go for normal, like for like, when you look at these charts, that's a good indice, a good indication of performance. So, Richard, do you want to talk through that chart that you've brought up?
Sure, yes. Look, this is a study we're just about to release where we were looking at how do you compare bonds, how they've gone over the long term, say 15 years we've chosen, and equities and hybrids. We put in hybrids there as well to really look at those three different. I'd kind of include hybrids as a separate asset class in between the two. So it's a 15-year study looking at three indices. So we picked the accumulation index because it reinvests the dividends.
ASX 200?
Of the ASX 200.
Yep.
And we picked the Elstree hybrid index as one of the only hybrid indices around. And then the corporate bond index, which is the sub-component of the Ausbond index. So it just looks at corporate bonds. And we looked at that over the 15-year period. And the results actually surprised us, which caused us to write a story around that, which we've just released. Because when you look at it over the 15-year period, of course, there was a GFC in there.
Yep.
And the GFC happened. It's history. And you can see there equities falling quite dramatically, and hybrids.
Equities are the green line?
Equities are the green line. And hybrids track down with equities because they are hybrids. And that's, in fact, their economic rationale for being is to protect senior bonds and protect bank deposit holders, etc. So they necessarily will track down with equities because they become more and more positively correlated when things get tough, I guess. But of course, corporate bonds didn't, and they're kind of slow and steady.
This is investment grade corporate bonds?
These are all investment grade corporate bonds. So to get into that index, you have to be an investment grade corporate bond. So when you look at the annualized returns, as you'd expect, equities come out on top because that's what equities are supposed to do, and they were about 8.6%, 8.68% per annum.
Yep.
Annualized returns. Corporate bonds were 6.96, but not that far behind.
Yep.
And hybrids were 6.2, which surprised us that hybrids were less than bonds because you'd intuitively think hybrids would beat bonds, but because of the GFC downturn, they didn't over that 15-year period. And then you look at the volatility of those indices. Of course, equities, they're more volatile than those other asset classes. The volatility was 15.28%. Per annum, and hybrids were 5.7, but bonds, being what they are, less volatile instruments, were 2.3. So it kind of the chart screamed out to us asset class diversification in the first place. Wouldn't we all have loved to have had a properly diversified equities plus senior bonds portfolio? Or, maybe some people had equities plus term deposits.
Yeah.
And hybrids are kind of in between.
So one of those things, when I look at that, a couple of things punch out to me. One is the sequencing risk. You wouldn't want to retire when everything was collapsing. So that's definitely a bad thing. The other thing for the viewers who are looking at this is part of the benefits have been the fact that the central banks came through and lowered rates and made everything much more valuable. So in the bond market, the consistency returns made it even more attractive because rates were lower. When this started, rates might have been at 6 or 7%, and they've gone down to 2. So that's what's happened there as well. What's your take on all that?
I think this is a very important graph. It reminds people that volatility is greater for shares than for fixed interest assets. And even the people who are very bullish for the outlook for shares over 3, 4, 5 years, as I still am, must allocate some of their hard-won saving into safe assets, the interest-bearing assets, particularly if they're coming up to retirement. I think anyone retiring needs 3, 4 years of their drawdown from their superannuation fund in very safe assets, including cash. And I say that even though interest rates are quite low, diversification, safe assets are very important. I think that's one very good point that comes out of this. Another one, I'd underline what Richard has said, that hybrids are not conventional fixed interest assets. I know a number of Australians who somehow believe that hybrids can be seen as part of their fixed interest portfolio. Hybrids are quite a different instrument. Richard said they're halfway between bonds and equities. And of course, the recent hybrids coming out to meet the new regulations for bank supervision are more equities than less fixed interest than before. So please, everyone, take notice what Richard said about the need for safe assets, the role of corporate bonds in all of that, and that hybrids are not conventional fixed interest.
Yeah,
And if I could ask Richard a question.
Sure.
You haven't mentioned bank term deposit rates, and would you like to make a comment about corporate bonds as an alternative to term deposits, given that term deposit rates in Australia have tumbled so much?
They have, and when we started out looking at this as a business opportunity, they were around 4 point something, between 4 and 5. You know, some special offers on the 5, and of course now they're you know, a 3 month is probably down, you know, at around 2.3 or 2.4, 2.5, depending on what you can get. So I guess that's part of our sales pitch, if you like, our education to brokers and planners is. Term deposits are down around here, hybrids are kind of here for greater risk, and senior bonds sit in the middle where they ought to sit. And so it really is a question of, well, am I happy with a very short term at call cash at, say, a cash management trust of 1.8 or 1.9, or would I take Woolworths risk and be looking at 3.1 for a senior bond, or do I want a hybrid and move further up but have the extra risk and the fact that maybe perpetual, it may well not mature and doesn't have the same sort of features then if it's not maturing. So we kind of see bonds sitting between the returns available on term deposits, which have obviously been great and protected people, but as you say, the yields on those have been collapsing essentially as a result of where interest rates are going.